Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Investing in agriculture doesn't mean you need to buy a farm. Agriculture ETFs let you tap into the market for crops, livestock, and other commodities without the hassle of physical ownership. Funds like DBA, Invesco DB Agriculture Fund, bundle futures contracts, giving you exposure to everything from corn to cattle. Whether you're looking to diversify or hedge against inflation, these ETFs offer a straightforward way to gain access to agricultural markets. They're a practical option for investors who want commodity exposure without the complexities of trading futures directly. Let's break down how they work and why they might fit into your portfolio. What are agriculture ETFs? Agriculture ETFs let you invest in the market for crops, livestock, and farming-related businesses without owning physical commodities. These funds bundle assets like futures contracts, stocks of agribusiness companies, or even livestock and grain price indexes. Unlike buying a bushel of wheat or a herd of cattle, these ETFs give you exposure through a single tradable security. They come in two main flavors. Commodity-focused ETFs, like DBA, track prices of raw goods such as corn, soybeans, or cattle using futures contracts. Agribusiness ETFs, like MU, invest in companies that produce farm equipment, seeds, or fertilizers. Both types offer diversification, but they work differently. Commodity ETFs rise and fall with crop prices, while agribusiness ETFs reflect corporate performance. How agriculture ETFs work? Most agricultural ETFs don't actually store physical goods. Instead, they use futures contracts, agreements to buy or sell a commodity at a set price on a future date. Here's how they operate. Tracking commodity prices. Funds like DBA hold a mix of futures for corn, wheat, soybeans, and other staples. As market prices shift, so does the ETF's value. Rolling futures contracts. Since futures expire, ETFs periodically roll them, closing old contracts and opening new ones. This can lead to gains or losses due to price differences between contract months. Dividends and reinvestment. Some ETFs generate income from futures trading or stock dividends. Others automatically reinvest profits to maintain tracking accuracy. Because these ETFs deal with futures, they're subject to contango, when futures prices exceed spot prices, and backwardation, the opposite. Both can impact returns over time. Key agriculture ETFs to know. If you're considering agriculture ETFs, these are some of the most widely traded options. DBA, Invesco DB Agriculture Fund, tracks a basket of agricultural futures, including coffee, sugar, and cattle. Ideal for broad commodity exposure. MU, VEGI Agribusiness ETF, holds stocks in companies like Deere & Company and Corteva. Best for investors betting on farm-related businesses. COW, IPATH Series B Bloomberg Livestock Subindex ETN, focuses exclusively on livestock futures, like cattle and hogs. Higher risk but targeted exposure. Each ETF has its own strategy. DBA is pure commodities, MU is equities, and COW zeroes in on livestock. The right pick depends on whether you want direct commodity swings or steadier agribusiness growth. Benefits of investing in agriculture ETFs. Agriculture ETFs offer more than just exposure to crops and livestock. They provide strategic advantages like risk management, inflation protection, and a stake in the growing global food supply. Here's why these funds deserve a spot in your investment strategy. Diversification and risk management. Putting money into a single commodity, like corn or soybeans, can be risky. Prices swing based on weather, trade policies, and even disease outbreaks. Agriculture ETFs spread that risk by holding multiple commodities or agribusiness stocks. For example, a fund like DBA owns futures for wheat, cattle, sugar, and more. Bad weather may hurt one crop, but others might stay stable or even rise. Agribusiness ETFs, e.g., MU, invest in companies across the supply chain, tractor makers, fertilizer producers, food processors. If crop prices dip, equipment sales might still grow. This built-in diversification smooths out volatility. You're not tied to one product's performance. Inflation hedge and global demand. Food prices tend to climb when inflation hits. People always need to eat, so agricultural commodities often hold their value better than stocks or bonds during economic uncertainty. Long-term trends back this up. Global population growth means more mouths to feed, projected to hit 10 billion by 2050. Rising incomes in developing countries increase demand for protein, like meat and dairy, which requires more grain to produce. ETFs like DBA or cow give you direct exposure to these shifts. Even if tech stocks slump, the price of soybeans or cattle might keep rising. It's a way to balance your portfolio against inflation and shifting consumer needs. These funds don't just react to short-term market swings. They tap into deeper, irreversible trends, like climate change affecting crop yields or global dietary shifts. That makes them a useful tool for both defense and growth. Risks and challenges of agriculture ETFs. Agriculture ETFs might simplify investing in crops and livestock, but they come with risks tied to the unpredictability of farming itself. Weather, policy changes, and global trade tensions can turn a steady investment into a roller coaster. If you're considering these funds, here's what could trip up your returns. Volatility and market sensitivity. Agricultural commodities don't trade like stocks. Their prices swing wildly based on factors you'd never consider with traditional investments. Weather disasters. A drought in Brazil can spike coffee prices, while a bumper wheat harvest in Canada might flood the market, crashing prices. Geopolitical shocks. Trade wars, export bans, or sanctions, like those on Russian fertilizers, can disrupt supply chains overnight. Disease outbreaks. Swine fever or avian flu can wipe out livestock supplies, sending meat futures soaring or plummeting. These ETFs don't just track economic trends, they react to forces like monsoons and livestock infections. A single frost in Florida's orange groves can send citrus futures up 20% in a week. That's great if you're on the right side of the trade, but brutal if you're not. Thanks for watching Part 1. Stay tuned for Part 2, where we'll dive deeper into the best agriculture ETFs to consider. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.